Good morning. Today is June 14th, year 2019, and is about to be June 15th, year 2019. This is Mijanur Rahman. So by this time, I'll probably start recording this video. It is most likely be June 15th, but anyway. So I wish you a good evening and good morning, at the same time a good night and good morning, I suppose. But anyway, today I'm going to talk. This is the video number. Is still the video number. Perhaps we should give it a new video number because we want to talk about slightly different stuff. So let's give it a video number, financial second series, video number 9, Financial Planning Tacit Knowledge Series. And today we are going to talk about the primary market, secondary market, and about the stock, why the regulation doesn't approve the stock or the going public, going through a company public financing. Okay, we'll also talk about the reason behind the reason why Securities Commission often do not approve a deal or approve a file or approve a public financing, and then also the financial shenanigans within the financial statements. So let's just start off with the primary market. And you would have to excuse me if somehow my voice is down or if you have difficulty understanding it. I would greatly appreciate your feedback. What is primary market? We talked about this before. Remember? IPOs, initial public offerings, or offering, if it is one company, if it is plural, that's offerings. So that would be a primary market, when the company issues shares or sells shares directly to the owner or directly to a prospective owner or prospective buyers. Now, often these IPOs are bought by large corporations or large investors or large buyer or institutional buyers, mutual funds, pension funds. They have a lot of money to back up. There are a lot of money or purchasing power. So they would buy that. At the same time, company that goes to public, they also have a serious risk of because these buyers are really powerful buyers because they want the bigger return for their investors, right? So they want to buy at a low cost at all time. Their policy is that they buy low, sell high, and always and hold it for long term, short term, depending on the need for their investments, right? So let's not talk about their objective, their goals, but let's talk about, as a financier, what is your goal as a corporation, as a management of that corporation? What is it you would like to do, and what is your role, and what would be your ideal, what would be your objectives to at the time when your stock or IPOs are offered. So anyway, so we already talked about this, but let's catch up with let's talk about a little bit more about the primary market now, so that you know, as a company, as a IPO issuer, you had to go through a rigid process of issuing that IPO to public, right? So whoever buys from you are the primary buyer, the primary owner of that IPOs or primary issuance, right? So this would be a primary market. So this would be a primary market. Now let's talk about the mechanism that they go through. you'd have to excuse me. I made some notes, but let's see if I could, so that I could speak to you point by point. So the idea of in the primary market, on the issuance of prior to issuance of the IPOs, they actually go through a rigid process of understanding an underwriting process and assessing their legal and financial risk. So the company's management, the board of directors, executives, middle management, and the operational management from the operation, they would probably sit down together and have a meeting about it, right? So where they want to go, their mission, vision, and so forth. Assuming it's laddering up to the board of directors, from the operational management to the board of directors, or from board of directors to the operation management, right? So most likely it is from the executive management to the operation, and executive management to the board of directors. So anyway, so they would decide how much money they would need, the executives, how much money they need for their project, and how much shares that are outstanding, and how much share that requires to be issued, right? So the company, when they registered that company, they have a company's bylaw, and then they are probably authorized to say, well, we can only authorize this much of share, the different kind of shares, and they can also amend that, I suppose, with the legal side, with the lawyer, and amend the corporation article, but. So the issuance of shares, the number of shares that's outstanding, and the number of shares that is issued, right, previously issued, and the number of shares they can issue, whatever is outstanding from and the remaining amount. So if the company is authorized to sell let's say 10 millions of shares, and they already sold 5 millions, they only have 5 millions, or they already sold 6 millions, then they would have 4 millions to go. So depending on the needs, they would offer or they would probably issue that share, or they would probably have the underwriters to assess the financing risk, assess the underwriting process, and the underwriter would look at they usually look at two different approaches. The underwriter, if they feel very strong about it, then they'll probably buy the whole issuance from the corporation, whoever the financee or the IPO issuing company, and sell it through investment dealers, right? So because the underwriters often it could be an investment dealer. So if not, then it could be an accounting firm. Associated with the but most likely an underwriter are often a combination of accounting firm and an investment dealer. So as you can see, as you understand something that they're very interrelated professions, underwriting, investment dealers, and then there comes to the legal team of the corporations. I wanted to keep them actually on the 6th level, but I think it's a good idea to layering them up on the top, because every decision the company makes, the company's management, and throughout whatever the decision the underwriter makes, everything has to go through the legal team for their approval, because they want to make sure that they are not getting sued by the existing shareholders for the new issuance, or whether the new issuance will affect the market price for the existing shares that is being traded in the secondary market. We'll talk about it in a second, a secondary market. So excuse me. So the fact remains everything has to be processed through or legally analyzed by the legal team of the corporation. Now, in this case, the IP issuer have a legal team. Their legal teams are different. The underwriter will have their own legal teams, and the investment dealer would have their own legal team. And anyone on the board would have their own legal team. Often the auditing firms who actually issues the the audited report, financial report, they would probably also have a legal team as well, right? Because they'll have to be compliant legally for their work, right? So remember I said the legals are often defending. It's good to be protective than curing. If we could protect something from a disaster, protect a corporation, protect something from upcoming disaster, then it's better to protect it than curing it, because curing could probably destroy reputation. Curing could take time, but if you know how to protect, then you know how to. It's like a hedging a risk, but protecting in this case would be, so whether there's potential legal sue that probably that may come from the existing shareholders or stakeholders or suppliers or vendors or anyone, or creditors or anyone, right? Because you want to make sure that the bond covenant. You also have to make sure that the issuance of any shares doesn't violate any bond covenant. So there might be a lot of limitations what a corporation can do, what it cannot do. And let's say, for example, for some reason, and usually the Security Exchange Commission wouldn't overlook that unless they made. So if there is, if later on it's found that there's a covenant on the company has outstanding debt, and on the covenant of the debt, that's it, they would have to maintain certain ratios to the equity. They cannot go beyond or over, or they cannot. Often they issue that so the company. There might be various reasons for that. Let's not talk about the reason for why there is, bondholders place the issuance or the covenant, right, on there, how much the company could maintain the debt to equity ratio, right? It's it's always on the lower side the debt and the higher side the equity, but it's always so anyway. So issuing a new share often may not be a legal problem from the bond side, or otherwise or the debt holder, otherwise it violates the bond, the debt to equity ratio and any bond covenant. Possibly the issuance of new share the question is, if the issuance of new share drops the market price of the existing share, it's a legal question whether there would be any sue by the existing shareholders. So again, if there is because of new issuance, if the share price drops, then the company has to look into the other options, right? And often you'll see a company that has the stock prices are really large in the market, and not probably $1,000 or something, or the book value of the stock price or the issuance of the IPOs are really large, or so they would probably issue a stock split and so forth. But let's not talk about that. So the investment dealer would have the regulatory, they'd be subject to compliance with the regulatory organizations, right? So that in this case it'd be SEC for Security Exchange Commissions, or could be, depending on where your localities are. So in Ontario, it is OSC, Ontario Securities Commissions. So you would have various, you would have various, obviously you can understand it's a night time. I'm producing this video roughly about 1, so I'm kind of tired, so you'd have to excuse me. So the company is subject to regulation, and these regulatory teams are actually in Ontario it is OSC, and often investment dealers, they might have their securities advisors or salespersons or investment advisor or portfolio managements or any of the professional that have investment license. Could be CIM, or it could be anyone who actually directly involves with this process known. They're also subject to regulations, right? So they are subject to compliance of the internal of the corporation, of the investment dealer. And now I'm talking about I'm kind of drifting away from the IPO issuers to investment dealer, right? Because you want to get a good, reputable investment dealer who could actually, or good underwriter who can actually sell your full stock, even if they don't take it full guarantee basis. They could probably take it on a best effort basis, right? Best effort basis, because you want to make sure that because you don't want to be a victim of hostile takeover, right, or hostile buyover. So this securities advisor also subject to the licensing with NRD, which stands for the National Registry Database. Again, excuse me. So you could find more about it, but it's not really a big task for the IP issuer, but rather the task for the investment dealer and the underwriter, right? But often it's a good idea to the IP issuers to look into it just in case at the time when the underwriter is only willing to buy on a best effort basis. Then you want to find out more about the investment dealers, right? So again, you would have to go through all those through your legal team, and your legal team will take carefully analyze each transactions, each documents to make sure that there is no potential legal suit, because that could be a problem. That could be problematic for your expansion or the reason for financing. Okay, so this is the primary market. The primary market is that when the investors, they buy directly from the issuers of the shares. Okay, so this is the primary market, and this, I suppose the company issued them the share certificate. So, and then once the IPO is approved by I'm assuming this is once the IPO, all the nitty-gritties, all the paperwork, all the regulatory tasks are done, then the Security Exchange Commission will approve the IPO and then the process, the pricing, and then placing on the market, and how the transaction will be done. The IPO will go through be sold through the stock exchange and so forth, or the investment dealer. But let's not talk about that today. Let's talk about a lot later, because we'll talk about that in details at some of the time. So for now, you need to know that the primary market is when the buyer of the stock, they buy the stocks directly from as an IPO from the issuer of the IPOs or shares. The secondary market, anything after that, once the company sell out the shares, once the company sells out the shares, anything that happened in the market is actually secondary market. So let's say, for example, you bought 500,000 shares from a company that issued 5 million shares, and out of that, you could be considered as a significant investors to this corporation. Or controlling. Depending on the amount of the shares that you have in your position on your or the ownership. So depending on that, you might be a controlling ownership, or you might have different kind of ownership. You might have something. You might have a voting right. The voting rights. You might have different kind of bylaw attached to the shares, right? So you might have different rights arising from the shares, right? So let's not. Each class of shares are different. There's a lot of, I think there's a lot of financial and legal work involved in this. So that's the primary. Excuse me, I'm a bit tired today. I think probably I should produce this video, but I have no other choice but to produce this video at this time. So from tomorrow, I'll make sure that they have a tea. I have my mug, but it's empty. I would have to get my tea and make sure that I have my tea tomorrow when I produce the other videos. But I'm going to try my best to finish this today. This